Hi, Adam.
Shonda,
Hi, Adam.
what's up?
Just living the dreams every day.
Oh, I know. How exciting was that appraisal
That was
news?
that was very exciting. I've had worse.
Yeah, it could be worse. So I feel bad. I'm like, man, Hannah, we're freaking just all kinds of learning experiences for her. I guess that's one way to look at it.
Yeah. Yeah, I told her pretty much the same. She should be getting on here too.
Cool.
Yeah.
Yeah, I think we have some good stuff that I think a lot of people will find valuable here. I see we got some other people on here. So hi everybody that I haven't met yet or that I have met. So I'm Adam with Keller Home Loans. Kayla's going to be joining me here shortly. We got some people in here also, so I'm going to try to keep everybody on board here. So um, I'm going to get started and just kind of go over what I've prepared here. So kind of our game plan was I was going to touch on a few things. Kayla has a few things that she's going to come in and she's going to go over with everybody. And then Jess was also going to be here today, but she is sick. So she had to go to the doctor. So she will not be joining us today. But um, so the first thing that I planned to kind of go over with everybody. So I put together, can you guys on the Zoom, can you guys see the screen well? Is it just one Zoom thing there? Because I can't see.
It's hard to read the small print.
Okay, so is it showing you? I want to make sure it's just showing you the one page. Like, does it say mortgage info cheat sheet or is it showing you like the next page?
No, that's all I see.
Swap.
Although you
Okay,
are
how about now? Does it just show you
We just see your head.
yeah.
just my head? Oh goodness. Oh, did I share my screen?
I was
That might be
gonna say,
why.
share the screen.
Look at, if I knew technology, that would be super. All right, this should be helpful. All right, so let's start now.
There you go.
Sorry guys, bear with me. First time doing this, so thank you. All right, so I'm gonna display settings and I'm gonna swap this. Okay, cool. All right, now it should just be one red screen that says mortgage info cheat sheet that should be legible for everybody, right?
Yes.
Okay, so basically this is a cheat sheet that I made. This is really helpful, I think, for newer agents for a quick reference when it comes to working with clients. So when you have people that come to you and they have questions or they have concerns about whether or not they can qualify for a mortgage or they can buy a house, this is something you could pull out really quickly and say, here's what it looks like, or if they have specific questions, and can help you with like a quick answer to their questions. So seller's concessions is the first one on the top left there. So Kayla's going to touch on that, so I'm not going to go too far into depth on that. The next one is bankruptcy. Okay, so when it comes to bankruptcy, there are different types of bankruptcy. There's a Chapter 7 and there's a Chapter 13 bankruptcy. You guys don't need to know this, but as far as just when it comes to the wait timeline requirements, if they have had a bankruptcy, the minimum wait period for Chapter 7 is going to be 2 years. So the Chapter 7 is going to be your more common bankruptcy. That's when someone files and it basically wipes out all of their debt. A Chapter 13 is a little bit different, because a Chapter 13 is where usually they make too much money, they couldn't wipe out all the debt, and they get on a repayment plan. So the wait periods are a little bit different for a 13, but Chapter 7 is going to be your more common bankruptcy. So with FHA and VA, it's just 2 years. So that's typically, if someone's had a bankruptcy, that's usually going to be the first program that's going to work for them. USDA is 3 years, and then conventional is 4 years. So 4 year, like the conventional does have a longer wait period for that. Minimum credit scores, again, you guys don't need to know this. We will help them with that. So I always say, if your clients have questions about credit or anything like that, defer to the lender and just say, hey, listen, I'm not an expert on that, but I work with some really great loan officers who can help you figure that out. But I did include what the minimum credit scores are. And again, I think the biggest surprising thing in there is that FHA does go down to a 500 credit score, and it is possible to qualify somebody down into that range. It is just more difficult, because when you get to that kind of credit score, you're going to have a lot more assets. So it goes from 3.5% down to 10% down for FHA. Usually if somebody's credit's that low, they oftentimes don't have that kind of money, but sometimes they do. So there are occasions where it can work in that. The other big thing that I do want to touch on for the credits thing is that for down payment assistance, typically they're going to have at least like a 640 to 650 or higher. There are programs that go lower than that we have access to, that could go down to right around 600. They're just not ideal, because they require a second payment for that second lien that they're going to give you for the assistance and that kind of stuff. So really, we try to get them to where they can qualify for the better down payment assistance programs, that are those payments that don't require a payment for that second mortgage and stuff like that. And also, if anybody has questions as I'm rattling off this stuff, because I do talk quickly, feel free to stop me and I can go into more detail or whatever on these. And then you have your minimum down payment for each program, right? So FHA, like I said, 3.5% down is going to be your minimum. Conventional, which is one of the biggest misconceptions when it comes to mortgages, is a lot of people think FHA is like your low down payment program, but conventional as a first-time buyer actually has, outside of VA and USDA, it has the lowest down payment requirement. So 3% down is fantastic. And then again, VA, USDA are 0% down. Investment properties, which is important to know, is that when it comes to anything investment wise, they're single family, they're going to need at least 20 to 25% down. Multifamily, 2 units plus, they're going to need 25% down. So just important to know. Now on this, I also put a FHA requirements checklist. So as you're walking properties with your FHA approved borrowers, if you are not familiar with what that inspection is going to be looking at when they're out there doing the appraisal, I put this on here to just be a quick reference for you. So essentially what the FHA appraiser is going to be looking for is they're really making sure the house is in safe living condition, right? So they're going to make sure that like there's no leaking faucets. The chipped and peeling paint is the most common issue that is brought up on an FHA appraisal, but it's a simple fix. Literally, you scrape it, you paint it, and they go back out and re-inspect, and you're good to go. So you can use this checklist as you're walking properties to just make sure there's none of these big major issues that could arise. And at the end of the day, when it comes to, like I said, the appraisal, anything that's found that just doesn't pass when they're going through it, it can be fixed, and they just go back out and inspect it. So I think a lot of people get really hung up on being so scared about having either a FHA or a VA approved borrower because of the potential concerns of that. But I would say 90% of the time, I've never had a file that literally had a thing come up on an inspection that wasn't able to be fixed and they couldn't move forward with their purchase. So that's just a quick checklist there. Did I hear
Uh,
somebody on there?
Yeah, I have a question. So I don't see GFCI on your list there. That's pretty common still, correct?
Yes, yeah. So this was just like a quick list I put on there, but yeah, I definitely could add the GFCI on there. I know there should be something about electrical on there, but that is a good point.
Yeah.
So I also put on here some quick, most common mortgage like concerns that a borrower has when you try to connect them with a realtor. So these are the things that I think of when I think of my referral partners and what they're being pushed back on when they're trying to get the people that reach out to them to buy a house on why they won't reach out to us to get a pre-approval, right? So the first one is they don't want to have their credit ran. And that's super, super, super common that you're going to hear people say that. And so easy rebuttal there, okay? Number one, Keller Home Loans, we just do a soft credit pull up front. There is literally zero effect to your credit whatsoever for a soft credit pull. That soft credit pull will allow us to see all of the things on your credit report. It'll allow us to see what your credit score is. And if you can't qualify for the loan right there, we can help them put that game plan together. The other part of that is if they have come to you and they've already spoken to another lender, let's say they've spoken to like a Huntington or another like online lender where you've had a bad experience, the communication wasn't there, and you really want them to try to get a second opinion with us, you have a 14-day window from when your credit is pulled to be able to have a second opinion as long as it's the same category. So as long as it's a mortgage inquiry to a mortgage inquiry, it is going to count as one. So they could go to 1, 2, 3, 4 different lenders, and those credit pulls should count as one on the credit bureaus. Now, if they're going to Home Depot and Lowe's and applying for credit cards, that's a different story. But as long as it's the same type of credit pool, it will count as just one credit pool. So the next one, obviously, I'm sure everyone has heard this that's worked with people, is that they're concerned about the high interest rates. And so one of the things with that is that there are specialty programs that can help them with getting lower interest rates. So a great example of this is the OFA program, okay? Most people are familiar with OFA. It is a down payment assistance program. Ohio Finance Housing Agency, I believe, is the name of it. And so most of the time that is utilized to help borrowers who don't have their own down payment. That program also has the HEROES program, and that program also has the Grants for Grads program, okay? If the borrower already has their own down payment and they do not need the 5% assistance from that program, if they're a first-time buyer, that program also offers a significantly lower than market interest rate. So you can Google it right now if you were curious. You can just type in OFA rates and it'll pull up what the current rates are, and you would just look for the no assistance and what those rates are. And so if that person is a nurse or a firefighter or a police officer, they would qualify for the HEROES rate, which is actually even better. And then the next best is the Grants for Grads, so they could qualify for that as long as they've graduated college in the last 4 years. That rate is a little bit higher than the HEROES program, I believe. And then the last one is just your regular first-time buyer. It's still a better rate than what the market rate typically is. So there's those things, and then the other thing is that in that conversation about rates is you could also let them know, with working with a trusted lender like Keller Home Loans, we are able to kind of help coach them and put together a game plan. If a low interest rate and a low payment is really what their goal is, we can help them put a plan together on that. And I'm going to touch on that later on how they can do that. But I have an example where this is a client that I just helped, and her interest rate was like 5.6 something or other. And so we'll go over what we did there, how we made that work, and how we helped her keep her payment to where she was comfortable. I want to save more money. So that's, I'm sure, another common potentially thing you guys would hear from a buyer. So like, I don't have enough money saved, things of that nature, okay? So a good rebuttal to that, did you know there are programs out there that can cover not only all of your down payment, but also part of your closing costs? And another thing I think is kind of nice to know, as just a quick reference, if they're like, hey, I want to save an extra $10,000, I feel like I need more money. Every $10,000 that they put down on their mortgage only offsets their mortgage payment by like $60 a month. So you got to think, how long is it going to take this person to save $10,000 to save themselves $60 a month on their mortgage? Is that really worth it? where we can make it happen now. We could get you down payment assistance. We could get sellers concessions. And now you could literally buy a house. I mean, it happens all the time. I have a client who's one of the ones we're going to go over. Their cash to close at closing is probably going to be $0. I mean, I've had people get money back at closing. That's with like USDA with the over appraisal and stuff like that. So they don't need a lot of money down to buy a house, and that's a huge misconception. I think that is a very easy one to overcome. And then the last one is, I don't think my credit's good enough. And so that is a valid concern, because credit is going to be very important when it comes to qualifying for a mortgage, right? But at the end of the day, if they don't know where they're at, or if they know where they're at and it's just not great, we can still have them put an application in. And so the application, again, it's going to do a soft credit pull up front. So it is not going to ding their credit for us to take a look, review, see where the credit's at, and say, listen, Mr. or Mrs. Borrower, you know, these are the things you can do. We can get you put on your mom's credit card as a, what's the word I'm looking for, Kayla?
Sorry, an authorized user.
An authorized user. Thank you. So you can get added as an authorized user. So for instance, if someone has no revolving debt, which is like a credit card, that's actually really important for having a credit score. And so if they have none of that, a quick solution is you can have a family member who does have good credit add you as an authorized user to their credit card. And now that is going to reflect on your credit report as if that was your own credit card. So you could have someone who was like let's just call it a 600 credit score, do something as simple as that, and it could jump them up to where now they can qualify for down payment assistance. Now they can, you know, make this work, and a simple conversation with somebody can help them put that together. Most of the time with the credit thing, if they do apply and they don't qualify right now, it's really on the borrower to follow the plan, because I can't tell you how many times I have a consultation and I go over and I give them a specific plan, whether it's a 6-month plan or a 12-month plan or whatever. And then I set my follow-up and I call them and I say, hey, how'd things go? Where are we at with that? And they just didn't follow the plan. So really it's about how serious they really want to buy a house when it comes to that. All right, so that goes over my cheat sheet. I can share that file if anybody wants a copy of this. I made physical copies for everybody that's here. So if you guys want a copy, I don't know how, but if I can get you guys a copy of that. So
I have a question.
yeah.
On that grants for grads, is
Yeah.
that the undergrad, or does that also, is that like graduate degrees included or only undergrad? I'm just curious. Do you
I
know?
want to say, yeah, I want to say they have to have a 4-year degree. So as long as they graduated with a 4-year degree, if they pursue further education, that's fine, as long as they have a 4-year degree is what it looks for. I do believe. Kayla also shook her head yes.
Yeah, so it's a 4-year window post undergrad or
Yep.
grad.
Yep, exactly. So once they get their degree, they have 4 years from that moment to utilize the program.
Okay, thank you.
Yep. Any other questions before I move on from this here guy? Okay, moving on. All right, so the next thing I wanted to touch on is mortgage consultations. So when it comes to mortgage consultations, I think this is, in my opinion, is the most important part on the lender side of things. I say that because this is where we're going to sit down with the borrower, whether that's in person or I do a lot of mine on Zoom, and we're going to go over their finances. We're going to talk about payments. We're going to talk about how much money they have, and we're going to put a plan together so that way when they find a house, they know exactly what to expect on our side of things. So that way it goes smoothly on your guys' side of things throughout the contract, and they're not getting their final numbers and they're like, what the heck? I thought, you know, my payment was going to be this, or my cash to close is going to be this. And so what we're going to do is we're going to do some hypothetical, like real life consultations that I've done for my clients. And we're going to kind of walk through them like I would with them. And I'm going to explain to you guys a couple different scenarios on how we can make things work for borrowers based off of their goals in terms of finances. So just as a brief overview, okay, when it comes to qualifying for a mortgage, there's really 3 main factors that come into qualifying. Number 1 is your credit score. Okay, so credit score, I don't know if you guys can see this, but that mostly tells me, number 1, what programs you qualify for, because each program has specific credit requirements. And so if your credit isn't where it needs to be for one, then we're gonna have to find another way to make something work there. Credit also tells us what your pricing looks like, right? So pricing is going to be your interest rate. Pricing is going to be mortgage insurance, which that can be a big deal, especially with a conventional loan, because mortgage insurance can get very pricey very quickly if you don't have, let's just call it 700 plus credit score. If you're in the 600s and you're trying to qualify for a conventional loan, that mortgage insurance can jump very quickly. And same thing with points. So points is another, it's a risk factor. It's something we'll go over here in a little bit. The second key component when it comes to qualifying for a mortgage is your debt to income ratio. So at the end of the day, it's real simple. It's your gross income versus your debt. And then it also is going to factor in the new mortgage payment. Okay. So with that, that is one of the things that, again, each program has its own specific debt to income ratios that the borrower has to qualify for. And when it comes to that, we can get creative on our end. If they're not where it needs to be, we can do things like paying down debt or paying off debt to be able to get those payments off of their credit report. And now that's helps them get their ratios. We can also do things like buying down the interest rate, which can also help them get to where they can qualify. And the last key factor is going to be their assets. So this is also very important, very frequently overlooked with lenders, where they don't take the time to look at a borrower's bank statement to see where did the money come from that they're planning to use for closing. Great example of this, I have a borrower who he just, before he reached out to me to apply, he took out a $20,000 loan from Best Egg as of just a personal loan to use for his down payment. And so had I not taken the time to look at his bank statement before I sent him the pre-approval, and I just said, okay, he's got $20,000. I looked at his bank account, I seen 20,000. I took the extra step to go through his transaction history, and I seen a $20,000 deposit from Best Egg. And I said, hey, borrower, where did this come from? He said, oh, I took out that loan to use for my down payment. Guess what? You can't use that for a down payment. So now we have to literally deduct all of that money from his bank account, and now we have $0 to use. That's okay. We found a way to make it work without it. But again, this is one of the, in my opinion, most frequently overlooked things that can cause issues down the road for mortgage lenders. All right, so now we are going to walk through an average consultation, okay? So again, these are real consultations that I've done for clients recently. So this is your typical borrower with 20% down, and this is what my presentation looks like. So this is just a simple breakdown. These are not exact numbers. This is put together in a way that's simple, it's easy to read, and it's easy for me to go in here. I can plug and play different numbers. I can send them the spreadsheet so that way when they're out looking at houses, they can also make adjustments if they wanted to buy a more expensive house or if they wanted to put more money down. So that's this spreadsheet. This is my personal thing, and this is what I use for my borrowers. But in this scenario, this borrower was looking to buy a house around $200,000. He was putting 20% down, which would have him financing around $160,000 and 30-year fixed rate mortgage. So you go to the right side of that. So again, conventional loan, and then the right side in the red there, you have the escrow items, okay? So your escrow items when it comes to the mortgage are going to be the property taxes, which that is one of the big factors that affects the payment a lot. And you won't know the taxes until they have a specific house, okay? One additional thing with taxes is that, I don't know how much time, okay, we'll go faster. All right, so with taxes, each house has its own specific thing. So once they find a house, we can dial that in. Same thing with insurance. Insurance up front, when I'm doing my consultation, I don't know what it's going to be until they have a house and they get a specific quote on that house. I use an average insurance ballpark, which here I'm using 1,300, which is a pretty good ballpark. He's putting 20% down in this scenario, so there's nothing there. But if he was putting less than 20% down, there would be PMI, which all of those together, when you add the taxes and insurance on a monthly basis, the total escrow is $308 a month in this scenario. So now you get down to the blue section is the loan info, okay? So the interest rate for this borrower was 6.99%, and his total payment, which includes the $308.33, which was his escrow, would have been $1,372 a month. Then you get to the cash to close, and this part is key, okay? So there's a lot of things on here that I feel like lenders skip and they don't really explain. And then once the borrowers see the numbers, they get confused. They're like, why is it so much? So on and so forth. So the first thing, we know your down payment, that's whatever percent down you're putting. So in this scenario, 20% down of $200,000 is $40,000. Then you have your closing costs, okay? Closing costs are all of the fees from the different parties that are going to help you guys make the purchase go through. The title company is the majority of the closing costs typically. You're going to have an appraiser. You're going to have the lender fees. Our borrowers, for our Keller agents, they get a discount on our lender fees for working with us. So one of the benefits to working with the Keller Williams or Keller Home Loans is that your borrowers do get a discount on those. And then you have prepaids. This is probably the most skipped over one that's not explained to people. When you buy a house, the day that you close on the loan, your insurance has to be paid for in full, because that day, if there's a tornado that night, usually it's your house. So you have to pay a full year's worth of your insurance at closing. And then you also have to put in a cushion for your taxes. In Ohio, taxes are paid twice a year. They're paid in February and they're paid in July. So they got to make sure they put enough money into the escrow account. So when the time comes for the payment to be made, there's enough money in there. So your prepaids on this particular circumstance was ballparking around $2,200. And then you have points. So points are very simply a charge to get an interest rate. Okay. Points are based off of risk factors. So they call them loan level price adjustments, which can be credit score. It can be, are you a first time home buyer? It can be the property type. There are so many things that can affect what points are and where your interest rate ends up being. For this particular guy, it was going to cost him $2,200 to get 6.99%. So when you add all those together, this guy, his total cash to close is going to be right around $49,772.80. And then you can see in my special notes, this guy, his debt to income was really high. He was actually over the limit. So in order to make this loan work, I had to pay off a few of his credit cards to be able to get this loan to pass and go conventional. So this is a typical scenario for a regular borrower. Now we're going to talk about down payment assistance. This is your client that doesn't have a bunch of money saved. Okay. This is a deal I have with a legacy agent right now who's under contract. $159.9 is the purchase price. It's a conventional loan. So 3% down is their minimum down payment, which has them financing $155. 30-year fixed rate. Now this one, the only thing that's different on the escrow side of things is that there is PMI. Okay, so $31 is part of their monthly thing with their escrow, so that gets added into their monthly payment. Now you'll see on the loan info the interest rate is higher, 7.75. That is OFA's rates for being able to go with them for getting that assistance. So they're going with the OFA program. The two drawbacks to doing that program is, number one, the interest rate is going to be higher because they're giving you a large amount of money to help you with your down payment. The other drawback is that if they sell or refinance within the first 7 years, they have to pay back that assistance. So those are really the two main concerns. But most of the time, if someone needs the funds to help them buy a house, those are really moot points, honestly. So now we get to your cash to close breakdown. And this is where it shows that you can buy a house without having much money at all. So down payment on $150,000 or almost $600 or $160,000 loan or purchase. Sorry, down payment is $4,700. Closing costs are higher in this scenario. Why is that? OFA charges a 1% fee and a admin fee of, I think, like $400. So the closing costs are higher than typical because we're using them and they charge fees for using them. However, they're giving more than enough to be able to make up for that. Again, in this one, you have prepaids. Now, when you're using OFA, they do not charge points. So there is 0 points for that. Down payment assistance, they're going to get $7,995 to help them with their down payment and their closing costs. And then the agent was able to, yep.
Oh, whenever you get to a break, I just have a question.
Go ahead, yep.
So obviously, typically OFA, that's usually a first-time home buyer.
Mhm.
Typically.
Yep.
How do you break it down to someone who isn't a numbers guy, who isn't like going over everything, and just how do you dumb it down for them?
So the question is, how do you dumb down payment assistance to a potential borrower?
Yeah.
So I would say if you're, and are we having this conversation? They just came to you, but they don't have a ton of money right now, and they're just like, I don't think I can do it.
I'm not necessarily going to have that conversation.
Yes.
I'm saying, like, for you, so that way, because I think the average consumer is not necessarily the numbers, but they're just like, can you give me a house?
Yeah.
But also, we ran into a situation where we have a client, they used OFA, they bought a house, they were in a situation where they were renting out part of the house to like family and friends, and all of a sudden they're no longer there, so they can't really afford the house. So we're going to be helping them sell the house now. but we had to go back and explain to them about OFA and how they had the 7 years
Mhm.
and all the assistance. So, but they're like, we didn't know about that.
Yeah.
And I'm like, we know you did.
Yeah.
Because your loan officer went over it, but it's just, I feel like to making sure that they understand each line item.
Yeah.
Just because, to me, I'm a numbers guy, and right now I'm even having trouble a little bit following.
Yeah, I'm going really fast, in all fairness. Like, this is usually a very, like, it's me and you, and we're very slowly going through this one line at a time. So I follow you. But when it comes to like a very, like, let's say I'm having a conversation with someone that you just referred to me,
Yeah.
and they're like, I don't have much money, I don't know what I'm gonna do. It's a really, like, to dumb it down, it's as simple as, hey, did you know that there are programs out there that it will literally cover all of your down payment, and it will also cover a portion of your closing costs. And if you still needed help, we can actually ask the seller to help you with most of the remaining amount. So you could potentially buy a house with realistically probably less than $1,000 or $200 out of your pocket. So like that is as dumbed down as it gets. But when it comes to the other question was, he said he had a client that they didn't remember that they had to pay back the assistance. That is probably going to happen 90% of the time, because there's so much happening when you're buying a house. The little nuances of something like that, I could say that to somebody 10 times, and I bet you in 3 years when they go to sell their house, they're not going to remember that they had it. I think that's a human nature thing, and that, like, you're a numbers guy, you probably would remember, but I think like the average person, they just forget stuff. You know what I mean? And so there's that. Yeah.
So you're saying this program offers down payment assistance,
Mhm.
in this scenario, like $7,000?
Yep. 5% of the purchase price.
Where does that money come from? Does it come from a higher interest rate over 7 years? Like how?
Nope. It's literally a grant. So they just give them the money to help them with their payment. The downside is the interest rate is a little bit higher than what the normal.
It's a Ohio funded program.
Mhm.
So as long as they meet all the qualifications, and they're more strict on your debt to income ratio, they're more strict on your credit scores. And they go back like 3 years instead of the 2 years that we go back on tax returns. So they are a little bit more strict and they require a little bit more of the buyer. But they also set their own rates, which are oftentimes lower than what our market rate is. So it is a really great program.
Just out of curiosity, what's the rate today on them?
With OFA, if you Google OFA rates, because there's multiple rates, because they have different rates for government programs versus conventional. Then they also have different assistance amounts. So
For FHA today is 7.25%.
7.25.
For 5% down assistance.
And so just to finish up on this one real quick. So then in this particular scenario, the buyer's agent was able to negotiate $4,500 in seller's assistance towards the buyer's closing costs. So when you deduct the down payment assistance plus the concessions, in this scenario, their cash to close is $500. This is actually before they're going to get tax credits from the sellers and things like that. So realistically, these borrowers are probably going to bring pretty much nothing to closing. So that's this is actually not this is a real situation. This last one that I'm going to go over is a borrower that is very interest rate and payment focused. Okay. So this was a client that I got that she wanted the absolute lowest payment that she could get. She had a decent amount of money saved. And this is how you can help your borrowers, and you can overcome objections about people that are like, I don't want to pay a 7% interest rate. Okay. So what we did in this scenario was we did what they call buying the rate down by paying points, and we utilize seller concessions to buy the rate down significantly lower than what the market rate is. Okay. So what happens in this scenario is the buyer is only allowed to pay so much towards the origination charge before it doesn't pass what's called a points and fees test. So a buyer typically can only pay up to like 2.5 points until they get cut off, and they guidelines wise cannot pay any more to buy a rate down. You can leverage sellers' concessions, and those can be used to buy that rate down even further. Okay. So in this scenario, all of the same stuff we went over at first. This purchase price was $150. She was putting 15% down, 30-year fixed rate mortgage. One thing that is special about this option here too, she was super payment focused. Instead of paying PMI as a monthly payment, because she's putting 15% down here. So in order to avoid PMI, you have to put 20% down. So what we did was, instead of paying PMI as a monthly payment, you can buy it out as a one-time premium and just have a little bit higher of a cash to close and not have a monthly payment for your PMI. So that's what we did. She went with 15% down. She bought her PMI out as a one-time premium. That helps keep her payment low. Now you can see the loan info. Her interest rate was 5.625. That is, we can all agree, pretty significantly lower than what the market rates are right now. Okay. So that helped her get her payment down to almost $1,000 a month on a $150,000 purchase. Okay. So now the cash to close breakdown, same stuff. Close or down payment, closing costs, prepaids are about the same. The big difference here is you can see the points. Okay. So it was going to cost her $7,000 in points to be able to make this work and get that interest rate down. The buyer's agent was able to leverage and negotiate the $5,000 in concessions to help offset the cost of that. So really, she's only going to have to come up the extra $2,000. And then you can see also for the one-time premium, it costs her $700 to buy out that PMI. So all of those things help this borrower be comfortable to be able to buy a house, to get a payment where she was okay with making this work. And so those are just very specific scenarios, but that is literally the consultation that I do. And again, I know I went over a lot of that relatively quickly, but those are the things that once I have that consultation and then I pass the pre-approval over to you guys, I can have that conversation with you. Hey, this is what the borrower wants. This is their goals. If we're able to negotiate concessions or whatever it is that they need, now maybe they don't need it. It's just going to help them get there. But it really puts that plan together. So we are helping our clients and your clients be successful and, be able to purchase a house that is within their budget and they can make work. So that's what I got.
We'll have intermission. Does anybody want? I haven't brought pizza, nobody's eating. Does anybody ready pizza, there's drinks? Okay, I'll give you, help yourself. Don't feel like you're the only one. Yeah, he'll be the first one to go.
All right, so Kayla's gonna take over from here. And Kayla, I have this up. You just have to share the screen whenever you're ready to show this.
Well, you can throw it.
You want me to throw it up there? Okay.
Are we on Zoom?
I think, can you see me? Can anybody see me? I don't know what's happening.
I can see you, yes.
Oh, hi.
Oh, Adam's not
Hi.
visible.
All right. So I'm going to share the screen and then Kayla's going to take over from here. And if you guys have any questions or if you want that cheat sheet that I made, just let me know.
Adam, are you in the Keller Williams office?
Yeah, so I'm here in Legacy on Mondays. And then most of the other days we have an office right next to Jose's offices over there. So I'm in there usually like Tuesday, Wednesday, Thursday. So.
Thank you.
Yep. All right, here is Kayla. Thank you for listening to me, everybody.
So Adam did a really good job of covering pretty much all the bases. A couple of things that I just wanted to touch on is understanding the different product types. And it really is going to depend on your client's qualification, but in some cases it's also going to depend on the house. Okay, so for you, those of you who don't know me, I'm Kayla. I'm with Keller Home Loans. Adam, Jessica Faison-Baker, and Chris Lynch, we're all on the same team. So the nice thing about that is like we kind of all support each other. So if you have a question and you need to get a hold of one of us, obviously we're all available. Adam's in the office here on Mondays and Wednesdays, or are you Mondays and just is Wednesdays. Adam's in on Mondays. I'll be here on Tuesdays and Thursdays. So if you actually, I know it's like drinking from a fire hydrant when you have this much information, but if you want to set up a time to come talk one-on-one and kind of like get to know each of us, you can do that. And then we're your lenders like on hand. So one of the things I wanted to talk about is getting a lender partner and networking with lender partners and the benefits of that. So especially if you're new getting into the industry, and I know we have a lot of like freshly licensed agents in the room and on the Zoom. So if you're just getting into the business, this is going to be one of your secret weapons, is to have one of us on hand, because obviously you're not going to know all of this information. And I always say it is important to stay in your lane because you definitely don't want to give wrong advice to your borrower, but it's also very important to have some kind of understanding enough to be dangerous so that you can kind of help guide them and like they trust you. So you want to have a little bit of a foundation, and we're here to help with that too. We have tons of education opportunities. Where the third Thursday of the month we'll do a training, but we also have several online trainings throughout the month that you can access at your convenience. So those are all online, all through Zoom. Another advantage that Adam did talk about, how like if you have a client and you're showing them houses on an evening or a weekend and they're pre-approved with their bank who's not open until Monday, or Monday's a holiday like we just had, and they need to know what their payment's going to be and they're kind of scared to even put in an offer and they're going to lose the house, that's when it becomes really important for them to have a second opinion. Especially if, some of the big box lenders, they may not do a full pre-approval. They may do what we call a pre-qual. So they might have the borrower tell them what their income is. Now, whether that income is usable or not, it's up for us to verify, but they can tell us what their income is and we can check their credit. Some places will be comfortable enough looking at their credit and issuing a pre-qualification. In that case, they haven't verified any of the information. So be very cautious of that. A lot of times I know like Rocket Mortgage, I'll throw them under the bus because we don't have any Rocket people in here. Rocket Mortgage will do that. They'll send a pre-approval, but they really haven't verified much. Just like Adam said, it takes that extra step to go through the bank statements to see if that $20,000 deposit was usable or not. And that really does save a lot of headache and running around for you guys, because when your client is comfortable with knowing their numbers and their mortgage consultant has walked them through the numbers, then that's less houses that you have to show them because they're going in more comfortable and confident with their purchase power. So very, very important. Another benefit to using us is the fact that we have so many programs available. There's really not a whole lot that we can't do. We have tons of brokers. So whereas a bank might be for programs, and if they don't fit into those buckets, they can't help them. Mortgage is not a one size fits all. So we do a really, really good job at fitting people, a tailored fit to the products that is going to be best for them. And you can see that we really do all of our homework to see how we can best help them. I have a closing right across the hall, like literally right now. I just said hi to them. They're doing OFA and they put $500 for their earnest money deposit and they're getting $60 back at closing. So they literally didn't have to bring anything else to closing. They're getting their keys as soon as they sign and they're happy campers. Another obstacle, and this was also mentioned, but your clients have a 30-day, this is very, very important. This is going to be one of your like number one objections. If they come to you with a pre-approval, we all know as realtors, like there's a lot of things that are out of your control. It's very important to gain what is in your control. You may not know the lender that they're handing you the pre-approval letter for. It will do you good to call them and get a conversation with them so you kind of have a pulse on it and see how reachable or accessible they are. But it's also going to be good for you to advise your client, hey, I have no doubts that this banker is going to be able to get you a loan for whatever amount they say they are, but let's do our due diligence and let's call this other choice, or maybe one or two other choices. They have a 30-day window where they're allowed to shop mortgage rates without further impact to their score. So like Adam said, we are going to start with a soft credit pool. That's not going to impact their score. If they want to go on with a full pre-approval for an FHA loan, we will have to do a hard pool. But in that case, if they've done their first credit inquiry within that 30 days, it's not going to hurt them anymore beyond that first pool. Okay. So that's what a lot of people have the objection. So you've got two things in your back pocket. So either we can just do the soft pull and get them a quote, or we can do a full pre-approval within that 30-day window and get them a couple of options. You want them to do the shopping kind of upfront at the pre-approval, because if they get under contract and they find out that they have an extra $7,000 of closing costs that they weren't expecting, And now they feel like they're stuck because they don't really have time to shop around when you have your contingency windows where you have to sign your application and have your inspections done. That is not the time to shop. The realtors don't want them shopping during that time. The sellers certainly don't want to see a new pre-approval letter or a new lender pop up. So if you can get them to look into other lender partners at the beginning, it's going to save you a lot of kind of anxiety and possible headaches down the road. Do we have any seasoned agents that want to chime in on? Do we have some scenarios here? Mike, Mike.
I apologize, I got here.
You're good. Have you had any clients that came to you with a pre-approval letter that like maybe you weren't unsure about and you got them to talk to somebody else because, or maybe you didn't get them to talk to somebody else and it ended up biting them in the butt when they got under contract?
Okay, so yeah, and I'm just gonna throw rock plus twice here.
You're in a safe room.
Yeah. Basically, I had a client, they go through and they get a pre-qualification with Rocket Mortgage. And I explained to them like, hey, you know, I know that this means that you sent some information in, but they haven't done a full pre-approval
yeah.
for you. You know, are you sure you want to move forward? And yeah, we did. We go through and we put an offer in, it gets accepted, we go through inspections, we go through appraisal, things are looking good. And I had talked to the loan officer beforehand, just said, hey, I want to make sure this is legit. He's like, oh yeah, they're definitely good for it. Everything they talked about, definitely good for it. We go through the appraisal after they spent almost $1,000 on inspections and appraisal. And then I get a call saying, hey, they're not good for it. Killed the deal. And I had asked them multiple times, like, either can you verify your information with Rocket Mortgage, or do you want to look at a second pre-approval? Absolutely not. We're good. The loan officer keeps telling us we're good. And I felt bad for the client because, you know, they're in a situation where they were out $1,000. Me and Tara, we did do our due diligence trying to see if they would switch over, and talk to somebody else, or at least get a full pre-approval. And they ended up killing the deal. There was another one, but that's the one that sticks out the most for me. But yeah, I've had other people where they do go through and they get a pre-approval, but they're like, okay, the loan officer's just not talking to me, and we switch over to somebody that, you know, we know, and all of a sudden the communication is way better, and they're actually able to get the approval, and then we close on the deal. So sometimes a second look is absolutely worth it. So they find somebody that they're driving with and that is local too. The one thing I'll say, you know, having done deals with you and then some other loan officers that are local, is the fact that you guys actually pick up your phone. Whereas sometimes dealing with a big bank, they don't work the weekends, and you're out you're out on a Saturday night and you need a pre-approval specifically for that house. You'll pick up the phone and write that for them. So yes, I have had deals like that. I could probably have a few more to talk to, but
You don't want to have to learn the hard way.
it sucks. And actually, that's something that me and Tara took away from us, is that when somebody comes in with a pre-qual and they won't make the adjustment, we'll actually tell them, hey, it doesn't sound like we're the agents for you then, because we've run into these situations before, and our recommendation is to go out and get a full pre-approval. If you feel like you need to go work with another agent, that's perfectly fine. And we'll let some people go. Other people will be like, oh, let me work on it, and then they actually do get their credit pulled and find out they're not good for it yet, but you get put on a plan for maybe 3 to 6 months from now that you're good for it. So it saved us time as well, because we won't take a client on that won't get a pre-approval first.
Yeah. Yeah. And to your point, I mean, the communication is definitely key, because we're all trying to get them to the same closing table, but it takes both of us, right? So we have to all be rowing in the same direction. And sometimes some loan officers may not have open communication, and there is confidentiality that we have to keep. But there are times where I can say to my client, hey, I really think your agent could use this information. It'll help all of us get the negotiation to get you in the best position. At KW, our motto is win-win, or no deal. And in our case, we really do feel like, we're the third piece. So we want to win. We want your client to win. We want you to win. And we're going to do that as a team. So, that's the importance of networking with a good loan officer. You're not going to be able to turn every single client to the lender of your choice, but it is good to have somebody on hand, because I have realtors that don't really send me anybody, but it might be a weekend and something popped up at a showing and they wanted to know, how VA feels about knob and tube wiring, and they shoot me a question. Totally fine. That's what we're here for. We're a resource. Use us. Ultimately, we want to be in partnership with you, and be on your team. And help you succeed. So that's what we're here to do. I also wanted to touch on some of the other down payment assistance or no down payment programs. So I have up here the seller concessions or max contributions for all the loan programs. I will say, like, when we're as an agent, you're going to be looking at, what does FHA, USDA, and VA require on the appraisal. USDA and FHA are going to be very similar. So that list that Adam gave you is going to apply here. VA can tend to be a little more strict because they want to make sure that they're putting their vets in a very solid house with very minimal investment that they might have to pay out after closing. So we have those experiences. Our friends there down south from the Tusk office, they could see a lot more of these USDA offers getting accepted now that the market's slowing down a little bit. USDA is a really great program. It's not down payment assistance. It is 100% financing. They don't have to have a down payment at all. There's no second lien put on the property. The rates are pretty comparable. Sometimes they might be a tad bit lower than FHA actually. Then this program is geared to let people under a certain income level to try to bring them away from buying in the highly populated city areas and get them more toward like the rural areas. So it is government backed. We do USDA guaranteed home loans. There are also USDA direct home loans that they can apply with. But that is a really good program when you can get 6% from the seller, and maybe you offer a little bit higher as long as the house is going to appraise, so that the sellers actually net close to the same, if not the same. But then like I've had so many people. I used to specialize in this, so our Tusk friends know. We've had so many people get to the closing table with literally no money out of pocket. They have good income, they have good credit. They just sign on the dotted line and they start building the equity in their home. So another really good program to be aware of. And you would be surprised the areas that do qualify for this program. In fact, Canal Fulton is the closest. Parts of Louisville qualifies. Something to keep in mind. There is a map online, but if you want to shoot us an address, we can check for that too. I was going to talk on credit scores and their impact. I know Adam did a really good job of covering all the credit scores. And it really, yeah.
I'm sorry. 2 questions. Does Hartville qualify?
Yep, a lot of Hartville does, yeah.
Right. And is it land as well?
It is a lot of our land. So I don't think we're qualified to do USDA land loans. That would be a direct program. Can you confirm that?
No, yeah, I don't believe we can do just land. And if you're ever curious, you can just Google USDA eligibility map and you can plug in the address and it'll tell you whether or not it would qualify.
Yeah. It will give you the exact, and I've had addresses that are across the street from what qualifies, that are like just outside. So you want to make sure that you put the exact address in, it'll tell you.
So if it's in Hartville, what was the program?
They would want to contact USDA direct. Yep. Credit scores. We do have multiple tools. So soft pulls are always an easy way. A lot of people are self-conscious about their credit. If they're dragging their feet, it's not usually because they don't want to buy a house. It's usually because they're worried about their credit history, their credit score, or they're worried about cash to close. So like Adam said, if we can just overcome that objection for you guys, that will bring you a lot more business. So it's never too soon to know your numbers and look at those. But the nice thing about it is too, I don't know, do you ever refer out to like credit repair agencies?
I don't usually, because it's hard to know if you can fully trust them,
Correct.
and then they're not gonna take that client and try to sell it to somebody
Right.
else.
So a lot of lenders will refer out to like, Lexington Law to do credit repairs, and they'll take a monthly fee. And at first, like, your score's gonna go up because what they do is they dispute everything. And then as those disputes come back, their score will probably come down a little bit. But meanwhile, while they're disputing these things and sending out letters, they're collecting a monthly payment. I'm with Adam. I don't like to send them out to those places because I don't know if they're gonna be taken advantage of. I don't know if they're actually gonna be doing what they say they're doing. And also, you don't know if they're gonna be selling that lead back out to some other lender that you don't know. So in our case, we have two different credit tools. We have a Wayfinder and a What If Simulator. They are great tools. They are free to all of our clients. We don't charge our clients for any consultations, any application. The only thing that we do take an upfront fee on is if we do what's called an offer ready pre-approval, which is kind of nice in a competitive market. So on top of our regular pre-approval, we will collect a $295 deposit, send that file to underwriting, meaning they're going to have a complete review, and now they're approved as a buyer. And then all we need is an appraisal and title work. So essentially, you get them under contract and you can offer them a 15-day close. So that's called offer ready. That's our regular pre-approval. Everything else is free, including these credit tools. The Wayfinder is basically going to allow us to say, okay, this client has a 580. We need them to be at a 620. We're going to plug in 620. It's going to go through the report, give them step by step what they need to do, and it's going to give us a time frame. We're going to put them on our calendar for that time frame follow up. We're going to give them all those instructions. We're going to let you know when you can follow up with them, because that just helps us all get them to the closing table and to the finish line successfully. And a lot of the tools that we give them are going to be things like, paying down credit cards, paying off collections, things like that. The nice thing about the second tool, the What If Simulator, is the What If Simulator is going to allow us to do things like add them to credit card as an authorized user. So the authorized user is the scenario where they get added to somebody else's credit card, and then instantly they're added with all those years of history, then the available credit to their trade lines. That doesn't necessarily reflect when we do the Wayfinder, but in the What If Simulator, we can put the credit card in. We can say when the credit card was open, we can say the limit, and we could say the balance, and that'll tell us what kind of outcome we're going to have on their credit report. Yeah.
Once, let's say, it's a parent saying, my kid doesn't have the credit history,
Mm-hmm.
they wanna buy a home. The parent puts them on as an authorized user on the card. After the child buys the home, can they just call and take them right back off?
Yep. It's very easy on and very easy off. Yep. Yeah. So they don't have to maintain that credit. What she asked was, do they have to stay on that credit card after they've purchased a home? The answer is no. They can be taken back off of it. I mean, their credit score will probably drop as instantly as it was brought up, but that's absolutely an option. And I tell a lot of people too, they don't have to have an actual piece of plastic to be added as authorized user. So unless they got really crafty, they wouldn't have to have a direct line to that credit card. Yeah. So it is fairly low risk. But a lot of ways, we also have alternate trade lines that we can add. So if they have a good credit score, but they just don't have 2 or 3 trade lines with history, maybe they have a good credit score because they opened up an account 6 months ago and that's all they have. We might supplement their credit too. So we can add different things like their gym membership, their car insurance, their Netflix bill. I know a lot of people now are using Experian Boost, and in that sense, they're actually adding the trade lines themselves. So those trade lines are going to report automatically. They just pick up off the payments off their bank statement. And the nice thing about that is
Once we see that on their credit report that it's self-reported, we don't have to count it in their debts against them. It doesn't impact their purchase price. So that's another nice thing about supplementing.
How long does it take to show up on the credit report for you to use when someone is added as an authorized user?
So, they'll be able to see on their consumer reports or their apps, they'll be able to see it right away. I tell people wait about 30 days
30
before we can update our credit report. And I have somebody waiting 10 days right now because they had the exact same situation. And we pulled a soft pull and their score they jumped about 60 points. So in about 10 days, we should be able to get that report. Another tool we have in a pinch, and I've used this when we have clients that were denied by other lenders, and we need to do a little bit of last minute saving, is we can do a rapid rescore. We don't jump to that because it can get a little bit more messy and it's not as rapid as it sounds. But if they do something to correct their report, we don't have to wait the 30 days. We can pay to manually have it updated and be able to have access to that in a hurry. So that's another tool that we have in our, back pocket. Does anybody have any questions online? We had some good questions in the room for sure. I just didn't check to see if our chat. Would a chat pop up here?
I don't know. I'm really bad. This is my first
You
time.
too. We just work here. That's what I say. And two, like we should probably see who all logged in. We'll send out all of our contact information. The nice thing about that, like we said, we're all available on weekends, evenings. Obviously, we do have personalized, but we all back each other up. So if there's something, don't hesitate. We don't want you guys to miss out on a sale. I saw a chat box pop up. We have chats. Hi, Deb. Can you send out the recording? Yeah, I think Amanda has all these recordings.
Okay, thanks.
Yep. Hi, Bree. Okay. I think that's about our time. If there's no other questions, I'm sure as scenarios pop up, you guys don't hesitate to reach out. We're happy to help. Do you have anything, Adam?
Nope.
Well, thank you guys for bearing with us. That was a lot of information, so
Yeah.
way to hang in. Thank you, guys.
Thank you.
Bye. There were a lot of people online.
I know. I got nervous.
You're more than welcome. That's funny. All right, I don't know. I pushed stop on something.
And at the bottom.
Okay. And it was recording.
Yeah, I think that's it.
Your in button looks different than my in button.
It's kind of like-